All right, good morning, everyone. This is Joe Henches with Beyond the Chart, and today is Saturday, January 11th, 2014. This is the Technical Analysis Stock Market Weekend Update. So we're going to go ahead and, yes, we'll come back to Apple and we'll spend some time on it. But today we're just going to focus on a couple key indices, USO, the oil ETF, and go to Apple. So I want to focus here on the Dow. It looks like the Dow has broken out of it's got a little flag. This looks like a flag to me. Okay, if this is the flagpole and this is a flag, then the distance that you would project when it breaks out of this congestion is from here, which is about 15, let's call it 950, up to 600. Okay, so that's about 650 points. You add that to this line here, we'd be talking 550 plus 650 up around 17,200. Okay, up into this area, up around in here, which kind of is the top of this channel that I've got projected, which is this I've got this trend line from this point to this point and a parallel line projecting out here for a potential top of the channel. Now the other thing on the Elliott wave count is, again, here's wave 4. We're looking at a wave 5, which would be the final wave before a major correction. And I was counting 1, 2. This could be 3, and then a 4. So I'm not really sure. Let's just, I'm right now more worried about just watching the wave structure and see how it plays out. We're getting some indication on the other indices that it may be starting to break out. So let's take a look at S&P 500, little different view here. It's closed near the high of the day, and the high of the last highest close of the last 7 days, something like that. So that's nice. It looks like it's kind of popping out of it. The Nasdaq, very similar. It's up near the top of the congestion of the last week or so. And then when you look at the New York Composite, similar scenario, actually even more bullish on the New York Composite. It is above the range, the trading day ranges of the last 2, 4, 6 days, okay, and closed near its high for the day. So that's very nice and very, very bullish. So that gives me the indication, the back here on the Dow, there's a good chance this thing is going to break out and run out of here. So we will see if Monday and Tuesday if that starts to happen. I want to come back to the Dow weekly. This is a formation I've been watching for months. For a long, long time, actually, because this is a potentially very bearish scenario here. This is what we call a broadening top. And you've got 0.1, 2, 3, 4, 5. And broadening tops were originally became bearish because it was a formation that was seen in a lot of charts at the top in 1929. So over time, it's just carried that bearish association with it, and that's the way it's played out. And so when you look at this, there's nothing. I mean, it could throw over a little bit more above beyond a side. That's why we're up in this scenario though where it could turn, and that's why on a daily basis and on the indices and indicators, we're really watching closely for any kind of breakdown at all. So that's why I wanted to make you aware of. We are up in this danger zone, in my opinion. Now, we could come around and break back down and then rally back up in what they call a 5A. If this is 0.5, this becomes 5A. It's kind of like a small counter move, and then it breaks back down and breaks down, and the formation completes itself as it breaks below this point here. Okay, now that's a pretty bearish scenario. All I can tell you is I've seen this happen on stocks many times. Okay, this is not something that's happens once in 20 years or something like this. This happens many times in stocks. So we're keeping an eye on this scenario. So that's kind of the weekly thing to really keep your eye on. Real quick on oil. Oil's been very choppy. This is a weekly chart, and if you look at, this is the lowest point of the last couple of years in terms of the intraday low on oil. So if you mark this as the low, and it looked like we had a move up here and a possible ABC correction here for a wave 2, and then a new 5-wave move as an impulse wave up. It can't be 3 because 4 cannot overlap the top of 1, so this is potentially the first wave in a third wave, and then we get a correction back down. So I'm actually looking for this to be to turning around, for the correction to kind of stop and turn around. So we'll look to see. A lot of people are very bearish on oil, and usually the crowd doesn't get it right. So we'll have a tendency. I'm going to be watching that pretty closely. Let's talk about Apple. This is a scenario I've been talking about now since October, November time frame. And this is a bearish, this is rising wedge. It's breaking down. It's breaking down through this trend line. And as it continues to break any support points, especially this one right here, it's going to become more and more bearish. Now, on Friday, I tweeted on StockTwits that I thought Apple would see 400 before it ever saw 700 again. The reason is because when you break down out of a rising wedge, it typically moves fairly quickly, and it goes to the bottom of the wedge. That's where the target is, and that's 400 to 390 in this area. Okay, and we are in a bearish scenario. The other thing I wanted to point out is this rally, this entire rally, has been very weak. If you look at the 50-day moving average, okay, at this point when the wedge kind of started, the average 50-day moving volume was 15.4 million. That's this dotted line I tracked down here, okay? Friday's close, yesterday's close, the 50-day moving average is 10.8 million. So that's a 33%, about a third drop off in terms of the average 50-day volume that's occurred in this entire rally, okay? That's not strong buying that's coming in this rally move. So that's one, that's just another reason why I'm looking at this. And then when you look at Apple on a weekly basis, if we look at this point here, which was the low point of the last, I don't know, couple of decades probably, but this is when Steve Jobs actually got it put in as the reinstated as the CEO at Apple, okay? You had this wave 1, wave 2, wave 3, wave 4, and wave 5 top up here, and now we've broken this trend line of these two corrective points, okay? And here we are in this rising trend line. Now, nothing goes up forever, okay? And you corrected this big move, you corrected back down. Look at that correction of that move. Okay, you had a nice big move, you had a smaller correction. Well, typically the wave 2 correction is the deepest, wave 4 is more shallow, okay? And now we've got to correct this entire move from 0 to 5 needs to correct. Okay? And so right now, all I'm calling for is a move back down here to 400. That doesn't look so big when you start looking on the grand scheme of the kind of move that's occurred over the last 16 years. So we will see. And again, all I can do is look at a chart and say this is the supply and demand scenario. I don't care what's happening with contracts with China Mobile or anybody else, China or whatever, I know Icon's playing around in Apple too, but all I can do is look at the chart and say, what is the chart telling me? And this is the picture, the scenario that it's painting out. This is the supply and demand scenario. Now, that's not to say, just like at any chart formation, that it can't fail or morph into something else. But my best assessment at this point is that this is a bearish chart formation, and that the projection for where the target would be is down here around 400. So anyway, that's it for today. This has been Joe from Beyond the Chart. We'll be back tomorrow with some trade ideas for the coming week and updates on the ones we had for the last week. Hope you have a great rest of the day, and talk to you tomorrow. Thanks for stopping by.